Okay, today we're talking about itemized deductions, or what most people call their write-offs. So basically every year when we file your taxes, you give us all of your income documents, your taxable income documents. We add all those up on the 1040 form, and then we get basically a number for your adjusted gross income. To calculate your taxable income, we subtract your deductions. And so that's either itemized deductions or the standard deduction. And it's basically whichever number is higher. So under current laws, the standard deductions are super high. For single filers, it's $13,850 for 2023. For married people, it's $27,700. So that's the number that you just get before even adding up your deductions or anything like that. So everyone gets those numbers just based on their filing status. And then your itemized deductions, you add up, and it's basically things like medical expenses subject to limitations, taxes, which include state income taxes and real estate taxes, capped at $10,000. Then it's interest, which is basically, mortgage interest on real estate for the most part. And then charitable contributions. So we add all those numbers up, and if they end up being less than the standard deduction, then they're irrelevant. We don't even bother looking at them again, and we just take the standard deduction. So one common misconception that I get a lot of, basically post-Trump tax law is that a lot of people think like, oh, I'm worse off now because I can't write anything off. I just have to take the standard deduction. But the reality is that under prior tax laws, the standard deduction was really low. And even after adding all those itemized deductions, yes, you were able to take them technically and actually write them off. But you were still taking less than the standard deduction is giving you now. This is for most people. It's not everybody, but for the majority of taxpayers, this higher standard deduction is a better tax outcome because they end up with lower taxable income than they would have under previous tax laws. So basically, every year we add all this stuff up, and if it's less than the standard deduction, it's completely irrelevant. So for most people now, in my world, it's probably like 70 to 80% of people. We add all this stuff up and it ends up being irrelevant. So, we're going to basically over the next couple of weeks do deep dives into each of these deductions so you can see how they're calculated. And then from there, you can figure out whether it's even worth gathering for your accountant every year or whether you should just leave it alone. But stay tuned for that.